Welcome back. So you're probably wondering, like, okay, so how do these fund managers actually make their money? Okay, fund managers, i.e. the people that got together to form the management company, this is how they make their money. There's two ways. The first is a management fee, okay? And it's normally around 2% of the capital invested for the first 5 years while they're investing, and then the second 5 years where they're divesting, it goes down to 1.5%. And the idea behind it going down to 1.5% for the second 5 years is because you're selling off companies, so normally there should be a little less work. So what this money is basically used for is to give themselves a salary, pay the rent on the office building, pay the salaries of their teams, real basic stuff. And it's probably pretty generous compensation. Okay. Then the second thing is the carried interest, and this is your bonus. Okay. So once the fund has divested everything, then the profits are split between the limited partners, i.e. the investors who invest in the individual fund, and between the individual fund managers, the actual venture capitalists. And normally it's an 80-20 split. 80% goes to the limited partners, the actual investors, and then 20% goes to the individual fund managers or the venture capitalists. Now this is normally only after a certain hurdle has been achieved. So the hurdle means the fund must have made this amount of money on average per year. It's normally 6 to 8%. I put in a hurdle of 10% here just so we can make the math a little bit easier in my illustration in just a second. Okay? But that's how they make their money. So they get a huge bonus, normally at the end of 10 years, and then there's also the management fee. Now the management fee is kind of interesting. So if during that first 5 years, as they've invested in the first 5 years and then they start divesting the second 5 years, if they start using those divestments from the second 5 years to reinvest in the next fund, this management fee accrues. So then, let's say, for example, they've made it to year 6 and they're divesting for the first fund and then they're using that money to invest in the second fund, they'll get 1.5% of the fund that they're divesting from and plus 2% of the fund that they're starting to invest in. And so this is a way for them to continue to expand their income. And again, that's 2% and 1.5% of the total capital invested in the fund, not necessarily invested in the portfolio of companies. Okay? So let's give an example, or let's just kind of talk through the math. I did a really easy number. Let's say we've got a real small venture fund. It's $100. Of course, you could say 100 million euros or whatever. The math is more or less the same. So for the first 5 years, now, like for year 1, they probably haven't invested all that money. Maybe they've only invested $10 or $15, whatever. It doesn't matter. The management fee, even if they haven't actually invested all of the money yet, is still going to be that 2%. So you take 100 and you multiply it by 2% and you multiply that by 5. And you also want to subtract from the 100 times the 1.5% times 5. And that'll get you the number of $82.5, okay, $82.50. So what that means is, yes, they have raised $100 to invest, but only $82.50 is actually going to get invested, okay? So let's look at how our payout looks, okay? Now, this is not going to impact the hurdle because the hurdle, again, is related to the amount of capital actually invested. So there's a little bit of pressure because they don't actually start with 100, they start with 82.5, okay? But the way the hurdle says is the next year, because I made a 10% hurdle trying to keep the math easy, they've got to make 110, 121, 133, 146, all the way to 235.95 by the end. Okay, that's when that's how much they have to have at the end to reflect that 10% accrual every single year. So let's say they only just barely meet the hurdle, right? They just meet it. In fact, I rounded up here to 194 to 195 just to make the math easier. So let's say we just barely made it over that 10% hurdle, okay? So, or let's even say they made $236, okay? They just made their hurdle, okay? 20% of that goes back to the individual fund managers, so they'll get $47.19, and then the actual limited partners will get $188.76. Now you're probably thinking, well, that's pretty lame. Like they've invested that money for 10 years and they've only made basically another 88%. Yes, because I've assumed this venture capital fund only just barely made their 10% hurdle. Okay. You know, a lot of these funds, if you look at the statistics, are getting 15, 20% or more per year. And so therefore the payouts would be a lot higher. But I was just trying to do this to keep the math kind of simple. Okay. So this is how the compensation scheme works. Now remember, a lot of these individual fund managers also have invested 1 to 5% into the firm. So they may be 1 to 5% actual owners of the particular fund. So they've invested a lot of their own money in there. So they're also they're going to get the payout here, okay, from the carried interest, and they're going to get the payout here because they've cleared their hurdle. Okay? So they'll get a little bit of the 80 and a little bit of the 20. Okay? So that's how we're talking about venture capitalists making their money. I hope this little mathematical illustration is helpful. I'm looking forward to seeing you in the next video where we'll talk about trends in venture capital. I'll see you then.